you made number 2 in the world for the best performing growth capital fund.
If I had to say which is the most disruptive time ever for financial services, it's literally now.
In 10 years' time, no company will be a
because finance will be so embedded in
everywhere.
I don't even know what a bank is anymore.
Correct.
Or what a bank
and
does.
You want. And you want.
So actually, he says we are now piloting stablecoin across our entire network because it frees us up from these shackles of the 5
Because it's
p.m.
instant. And you can net it all 24 hours a day.
Yeah, and so for them, this was an obvious thing. How do we actually bring the customer relationship? We create a subscription service. I think it's the same thing for Apple. And this is going to be the battleground. Battleground is going to be who owns the customer. And that's why embedded finance is such a core part of the tool set.
Yes, wealth management needs to become and is becoming significantly more personalized, significantly more agentic, significantly more efficient.
That you've thus far described is incredibly disruptive to the status quo. But Bitcoin is incredibly disruptive to everything you've just described, isn't it? You're listening to Fund Shack. I'm Ross Butler, and today my guests are Matteo Stefanel and Udayan Goyal, the co-founders of Apis Partners, a growth capital firm focused on fintech. Gentlemen, welcome to Fund Shack. Apis set up in 2014 when you were a newly minted emerging manager, and you raised about $290 million off the bat. And that obviously went very well because a few years later in 2019, you raised $563 million. And then earlier this year in 2025, the first year that you were eligible for inclusion, you made number 2 in the world for the best performing growth capital fund. And that was also the first year that any non-North American fund had made the top 10. So that's the Oliver Gottschalk index, the Dow Jones one. We've got Oliver coming on the show later this year, actually. So you're obviously doing something very right. And I want to talk to you about what it is you're doing and how you can continue doing it. But first of all, I want to get a feel for where your conviction comes from. So back in 2014, what was it that made you think the world needed another fintech growth fund?
So we really met in 1998, where we joined a Wall Street firm called DLJ. On the same day, in the same team. So we were joining the financial services team. We'd both been in investment banking already. So the prior years, Matteo was at Wasserstein Perella. I had been at a firm called BZW, which was subsequently acquired by Credit Suisse. And we ended up at this institution, DLJ, which, by the way, was a fantastic institution. Yep. One morning, walking into the associate class and sort of got to know each other and became fast friends ever since. And we worked through DLJ, which then also got acquired by Credit Suisse, through to moving to Deutsche Bank around the 2004 period, all the way till 2009. So we worked all those years together and working very closely together in various forms. Matteo was running large parts of financial services across both Europe and the emerging markets. I was running global financial technology. We collaborated across that. We became best friends. We ended up I ended up being
best friends, which is the biggest achievement.
Indeed. So, Matteo was godfather to my children. I was the best man at his wedding. So it was a very, very close relationship. And in 2009, as you know, we had the global financial crisis, and it was a kind of an interesting period because one sort of sat up and said, what are we going to do at this point? Are we going to continue to sort of focus on investment banking, which at that point was sort of in decline. And there's a whole story around that, which, for another time. But what was starting to become very interesting is that we sort of developed a very interesting set of knowledge set. And that knowledge set was from our domain experience working in these industries. But what we were missing was any track record on the buy side.
But we planned it, actually. We really organized it. Uday wanted to focus more on fintech specifically, but with a global view. I wanted to focus on all financial services because our belief was that there was a space in the growth stage area. And so we wanted to do buyout in my case, VC in your case, and really do the crossover in terms of both geographies and subsectors and stages so that we could eventually, and this is not us kind of reinventing, the story and kind of drawing a linearity to it that it doesn't have, but rather we planned it, and every year we would actually sit down and say, are we ready? Do we have enough track record? record? Do we have enough credibility to start? And the reality is we didn't. One never has enough credibility. But there was a stage in 2012, I think, when we said, okay, let's give it a go. And so by 2013, I resigned, you resigned, and we started doing this crazy thing with absolutely, it was so difficult at the beginning. So many shut doors, so many people saying, you're not a spin-off team. You haven't actually invested together, which was not true because we invested quite a lot individually together. I co-invested with this fund. He co-invested with my fund.
So you did have some buy-side experience, but it wasn't necessarily recognized as kind of mainstream? So
we didn't have any as of 2009 when we came out of investment banking. By 2014, when we kicked off, we had accumulated enough buy-side experience. And I was working at a place that at the time was extremely famous. Now it's probably a little bit famous for different reasons, called the Barrage, which obviously famously blew up. And I hastened to add 5 years after I left. So, but it was a great school in terms of learning the job of buy side, which is very different from the job of investment banking. In investment banking, you see some of the elements of it, like M&A processes and ability to concoct an equity story, etc. But you don't see some of in fact, most of the portfolio management and the value creation that follows the specific M&A transaction. A lot of what we learned over the years in M&A came in very handy, especially for exits for us. We are very creative in terms of coming up with exits. We target strategic buyers as our preeminent exit avenue. And that comes straight out of having 15, 20 years of experience before doing private equity in covering clients. Effectively, the majority of the buyers of our assets are former clients of ours for the previous 20 years. And that's pretty unique, I understand, in terms of having a firm that has this type of depth of knowledge of the buyer's universe. And that's really what I think has contributed to our ability to exit in full our fund one within the first 10 years and to already have exits in our second fund that amount to one-time capital. So we're very exit focused.
Just explain to me how it is that you already know this buyer community. Is it a function of the fintech universe being relatively concentrated and your backgrounds?
Yeah, I think that's
part of it.
Yeah, a huge contributor. So if you think about our experience set in the lead up to when we left investment banking in 2009, we had worked on many of the marquee transactions, taking Visa public, taking MasterCard public, taking First Data private. So every major deal that you can imagine.
WorldPay.
And WorldPay, so WorldPay with Advent Bain. So what's interesting is many of those people that we were working with at that time who were sort of mid-level professionals in those organizations today are actually in the leadership of those organizations. So if you think of Michael Maybach at MasterCard, he was actually head of product at some point at that point. And
why were you interfacing with the mid-level if you're working on M&A?
Because typically you're working with the strategy teams in those organizations, right?
And also especially when you're an associate, for instance, which is really when you build the strongest relationship, or when you become a VP, you're interacting with people roughly at the same mid-level.
Sure,
It's your boss, it's the big MD that interacts. Then when we became senior, these people became senior too.
Yeah.
So actually at the heart of APIS, and this is really coming back to the secret sauce or whatever it is, our network, right? And this network is incredible. Now, to your point that you made earlier, absolutely right. It is actually quite concentrated. I think what people don't realize is even though the world is a very large place, the fintech community within that world is actually quite small because the people tend to move around quite a bit. There's a sort of group of people, a nexus of people that tend to move from place to place. And even if you don't know a particular person within that network, you're sort of 1 degree of separation away from that person. So it's one phone call and you get in front of that person.
I'll give a silly example without naming names, but the current CEO of one of our investee companies, we first met maybe 20 years ago when it was a First Data, and then it was in Naspers, and then it was in Pakistan for Telenor, and then we actually worked with him. We hired him to do due diligence on an asset that we were looking at in another country, and then. Or the other CEO of one of our portfolio companies, we tend to, kind of bring in people that we know and trust, used to be the CEO of Molly. And before that, he was number 2, 3 at WorldPay that you worked with. And before that, you
Global Collect,
worked at Global Collect to try and do a take private.
Mm-hmm.
So these are relationships that span 2.5 decades.
Right.
So the level of trust and, frankly, the knowledge that we have about individual capabilities is such that we can identify potential management team members, usually CEOs. We can identify what asset would fit into a strategic, strategy. So whether it is going to be into MasterCards or NTT or Network International, these are all strategics, or Apex, or these are all strategics we sold assets to. Based on the fact that we knew what they were looking for. And so we were able to build the asset to actually fit the template that they were looking to, the hole that they were looking to
and
get.
indeed, that's part of our process, right? So, I mean, now we're getting deeper into this, but...
Yeah, that's boring.
Our process is, before we actually buy an asset, we will ring up the 4 or 5 most likely buyers, we think, the 4 or 5 most likely buyers of that asset, and actually ask them. So they give us a nice menu of what to do, and then we build the company around the menu of what to do. And then when we go back, it's typically the same 4 or 5 people who bid against each other to acquire the asset. And over 90%, I think, as Matteo was talking earlier, we are very focused on strategic exits.
Look, at the cost of precluding some potential investments, we really don't like doing IPOs. IPOs take a very long time, and they are probably the right exit avenue for much larger companies than us. But we are a small company. At the end of the day, the companies that we invest in are kind of mid-market. And getting to an IPO for a company that is worth, let's say, $500 million to $1 billion is a little bit trickier. It's probably not what you want to do. So strategic buyers, absolutely. Secondary private equity, maybe. And what I would add, actually, Uda, which is, I said it was boring, but it's not. It's quite interesting, actually. The same network, the same connectivity is what enables us to identify the assets we invest into, to diligence them, because a huge part of our diligence is to actually call our mates and simply tell them, hey, what do you think of that asset? What do you think the pivotal points to diligence are? Are they good on tech? Do they have charismatic leadership? Are the products that you like, et cetera, et cetera? This is an essential component of our diligence. And then the interesting thing is that as part of that conversation, then we say, and would you buy that asset? What if we dress it up for you in 5 years' time and we add this and that? What should we add for it to be interesting for you to buy? You have this conversation 5 times. You got a buyer's universe. You got your diligence done. You've already got your management makeup done.
So you're making it sound like you're quite hands-on with regards to the companies that you're buying. To what degree are you kind of building the companies, not as a euphemism of growing them, but actually putting them together? You're saying you're finding the CEOs. Give me a flavor of that.
We don't do greenfield, not because it's not interesting. It's really fun, and the excitement of doing very early stage investments is something that both Uda and I are very familiar with, that we've done, and that in our private life we try to decrease it because we it's time consuming. But we love it. The problem is this is not what our LPs pay us for. They pay us for reliable, sustainable 3 to 4x type of returns. Whereas with those early stage build up, you end up with a 0 or 100 or 0 or a 10x. Now, having said that, we do buy and build platforms, because there you can see a lower risk and a slightly higher return. So DPO, for instance, is a good example. Cardling to an extent as well. These have been buy and build platform where we have identified the core entity and then all the bolt-ons that we can add. And we've gone and we've negotiated the deals and we've contributed management and we've brought even clients.
I'll illustrate an example that Matteo just touched on. I think the way you need to think about it, so firstly, we are not operators. No. So we don't go and operate companies. That's not our skill set.
And it's important to know the difference. We are asset managers. We're not managers.
Yeah, we're not managers. But we know the right people to manage. And as Matteo very eloquently put it, that we can find those right people and put them in. The second thing is that because we are knowledge investors, well, what do I mean by knowledge investors? Firstly, we're very sector focused. We're fintech only. That's all we do. That we live and breathe that. So we have knowledge, and our investee companies like perceive us more as a strategic partner than as an investor. Why? Because if you think about geographical expansion, value chain expansion, product expansion, we really contribute to that from the best of breed knowledge that we've collected over all the years that we've been in this industry, right? So we've seen everything in different countries. We can port best practice from one country to another. We can port the best products that we've seen, and we can really contribute at that level. At the next level, we contribute to M&A. As Matteo said, we're very good at M&A. It's in our blood. It's where we've come from. So in the case of DPO, which Matteo touched on, we did 5 or 6 acquisitions into that, really built up the revenues.
6
and 6 altogether, and built up the revenues. Took it to the size that we could sell it, and then sold it, and that was a very important part of the trajectory of that company. And then, as just to touch on the final bit, is the other thing that we do, which a lot of other funds or people without the network cannot do, is we bring the customers. And so, if you think yourself as a founder of a business, and a lot of the businesses that we invest in are typically founder-led and haven't actually had any outside capital into their company, and because they're typically massively profitable, they don't really need the outside capital. But they let us come in because they see this value add. So to give you an example, we invested in quite an interesting business called Tutuka, which is now known as Paymentology. And that business is a business that does financial services for non-banks and non-insurance companies. So give you tangible example, there's a mass transit system in Hong Kong. They have something called the Octopus card. And on that card, you can actually use that card to do other payments around Hong Kong. And they power that system. So that's an interesting example. So they provide that system.
But even store cards and retail, kind of store cards, MNOs, mobile network operators issue cards. So those non-bank issued cards.
Exactly. So we had Matteo and I used to work with a gentleman called Dan Marovitz,
who's a dear friend, and he's a speaker often at our annual investor conference.
Who today is the head of financial services at Booking.com. He was the CTO at Deutsche Bank. So when we were at Deutsche, he was the CTO. And we knew that Booking had quite an interesting problem set, which was essentially that they have a B2C business and they also have a B2B business. And in their B2B business, they have all these travel agents around the world that actually use Booking.com infrastructure to sell inventory. And so we thought about that problem set, and we rang up Dan. We said, look, we just kind of done this quite an interesting investment into Tutuka, and they have this interesting product, which is creating virtual prepaid cards, which acts like a mini bank account for each of your travel agents where you're trying to pay commissions to them, because doing that through the regular banking network can be incredibly expensive. And so he came in with his team, looked at the product, really liked it, and in the end became one of the largest customers of Tutuka, which we then sold a couple of years later at 6 times money, right? So it was a great investment for us. But that kind of connectivity to the customer set, so whether it's Uber or Booking.com or DHL, these are all real examples. We can bring those people in as real customers because we're in the B2B space.
Go on, sorry.
I was just going to add, there's another interesting element actually that you touched on when you talked about the fact that the majority of our investee companies, partner companies really, are entrepreneur-led. There is a slightly more nuanced element to what we do, and that is that entrepreneurs ultimately are quite lonely. Entrepreneurs usually have had to fight night and day. They know extremely well when, the kind of feeling at 3 a.m. when you realize you're not going to make payroll for the next month and what do you do? So the situation is that you have these extremely driven, very creative individuals, very motivated, who have nobody to share it with. Now, Uda and I are entrepreneurs. We started our business from nothing. We literally put our savings in it at the very beginning, hoping. And we do remember the 3 a.m. thoughts like, oh gosh, what did I do here? We do remember it very well. And so what we offer entrepreneurs is not just the connectivity, it's not just the industry knowledge, it's not just the ability to identify exit processes as we usually tell them, you're not going to make money by selling to us, you're going to make money when we sell together. And that whole partnership. What they get is somebody to talk to at 3 a.m. when they have doubts. And this has remained the same regardless of the fact that we're now, 11 years older. And that's because we love it. We actually like that engagement. It energizes us. It's fun, frankly.
Yeah, this comes across.
Oh, good.
I'd imagine it really helps your deal flow because it seems genuine.
It is.
The fact that you're kind of entrepreneur friendly, but also just very transaction smart and you know your market. So what more can you ask for? Fintech is interesting. I think that financial services is being disrupted in a much more radical way than you would generally get the impression of if you were kind of a distracted observer like most people are. What are the next big opportunities in fintech? You've had a great run of it, but what's coming next?
Firstly, 100% right. I think if I had to say which is the most disruptive time ever for financial services, it's literally now. And why is that? We have a number of what I would call tailwinds coming into the industry, depending on where you sit, it could be a headwind or a tailwind. So, but
from our point of view,
from our point of view, they're tailwinds, and those are essentially one is Web 3.0, and Web 3.0 has now come of age. Web 3.0 has been around for a while.
What does it mean?
Web 3.0 is the whole stablecoin, Bitcoin,
decentralized finance.
Decentralized finance.
Yeah.
For many years, it was a little bit sitting on the periphery of the mainstream. Why?
But it was very much a solution looking for a problem.
Solution looking for a problem, periphery, because the regulators didn't like it.
Yep.
And so with the new US administration, they pushed very hard to bring this into the mainstream and create a regulatory framework which has made it now very mainstream. And that's now spilled over to pretty much all other jurisdictions. So this has become a real industry now, which didn't exist. But this has fundamentally going to change the way we think about financial markets, because financial markets, whether it's payments or everything, largely relied on some form of centralized authority or centralized technology. And now we're moving to this concept of decentralized finance and decentralized technology.
One use case to simplify things, we're not talking crypto here, or sure, but we're not. It's more stable coins for payments, for instant transfers. So many companies that you would never guess today already are using stable coins to actually do the treasury management. And rather than effectively using the banking system and doing SWIFT transfers and having large pools of capital in each country, trapped in each country. I mean, there was one large, don't name it, but there was one large European company.
Yeah, and anecdotally, I was a couple of months ago at a pretty big conference, and I set up a meeting with the treasurer of one of the largest companies in the world, and industrial companies. So they have operations in 120 or 130 countries, make large industrial machinery, and by virtue of being such a large company, they have to move money around, right? Because you have working capital that's required in your institutions, and so when you have a lot of working capital sitting within a very large conglomerate, what you're trying to do at the end of each day is sweep up all the cash and put it into an overnight deposit, because that gives you a return. Otherwise, that cash is doing nothing. So in a traditional environment, you need to anticipate banking cutoff times, right?
And not every jurisdiction is T+0. Yeah. Many jurisdictions are T+1, some even T+2, which means the inefficiency and the planning required. I mean, this is really complicated.
Yeah. So I went into the meeting thinking, I just wanted to kind of explore how these very, very large corporates were thinking about treasury management. So I went in and started to talk to him, and he was a little confused, like, why do you want to meet me? And I said, look, I wanted to like a little explore with you to actually see how you guys think about treasury management. For example, have you heard of stablecoin? Well, he says, of course we've heard of stablecoin. In fact, we're using it. And I was like, what? So actually, he says, we are now piloting stablecoin across our entire network because it frees us up from these shackles of the 5 p.m.
Because it's instant. And you can net it all 24 hours a day.
24 hours a day. So we can actually move the money around 24 hours a day. We can actually put it on deposit for an hour, for 2 hours, for 10 hours. It is a very flexible system. And ultimately, we think we're going to move our entire network to stablecoins. Now, think of that, because once you do that, all the big banks like your Citis and your JP Morgans, who are actually doing the cash management for these large corporates where they make a lot of money, all that gets sucked out of the traditional banking system and moves into the stablecoin environment. And so who's making money from these pools completely changes. There's an entire transformation, and that's just one example.
And that's on the large side of the scale. Then if you think about the nano side of the scale, micropayments. We've been talking about micropayments now for a decade. About micropayments is literally making payments for tiny little things like, I don't know, buying 10 points on your Fortnite, to buy a skin or something digital, something quick, something really fast. And up until now, it was either prohibitive in terms of transaction fees, or you had to pool and wait. I mean, that's the reason why you get a monthly salary rather than a daily salary, right? At the end of the day, if you think about it. But all of a sudden, if you start being able to do micropayments on an instant basis and without frictional costs, you can have continuous flows of income into and out of the individual. And that reduces the need for the individual to have personal indebtedness as well. So you can see a shift away from the world of credit into the world of payments. If you see the subsectorial point that I'm making. So it's really fun. I mean, it's really fascinating what is happening.
And actually, this is a good lead into the next big aspect of what disruption, which is artificial intelligence. Of course, it wouldn't be a conversation today without artificial intelligence. Yeah, but and I think the big thing that's coming to financial services with not the basic stuff, which is large language models being used for customer service and things like that. That's already there, right? The real stuff that's going to happen is agentic AI, right? Because you don't wake up in the morning thinking, I got to figure out what my finances are for today and, think about my deposit products. That's boring. You're really not interested in that, right? Most people just don't want to do that. So all of us are going to have an agent, an AI agent, and that AI agent is going to manage our finances, and it's going to talk to the AI agent of the bank, and they're going to talk to each other and actually deal with whatever we need to do on this micropayment aspect that moves you from credit into payments, because they're going to move around the money 24/7, instantaneously, make sure that you're maximizing your ability to use your liquidity in the right way, make sure you're maximizing the returns on your savings, putting it into the right accounts. So agentic AI is fundamentally going to change financial services, and those institutions that don't build the right infrastructure, the technology infrastructure, which essentially is the APIs where the agents actually interact and build their own agents to interact with these agents, are going to get left behind.
But that's on the individual consumer side. Then if you look at the impact of agentic AI, or in general generative AI, on pricing of products. If you look at, for instance, the concept of personalization of insurance policies, hyper-personalization is coming. In fact, it has been coming for a while. And AI is simply going to accelerate it. Now, that presents some very interesting problems, right? Because if I can price your life insurance to such a degree of precision, because I've got all your health data, I've got all your behavioral data, I understand. And when I say it could be you, by the way. It could simply be your own agentic AI that does all this analysis and then goes and actually prices its own policy. But if all of this data is utilized to price to perfection a product like insurance, an insurance policy, then my question to you is, what is the difference between an insurance policy and simply the net present value of all the future costs of your health management? What do I mean by this? If I can predict exactly when you're going to get ill, when you're going to have a heart attack, not you, but somebody, of course, et cetera, in reality, it's so precisely priced that I'm doing no redistribution of risk. And the concept of insurance, how insurance was born, was to redistribute risk from the individual to the group so that it could be affordable for everyone, both the ones that had high risk and the ones that have low risk. But if you continue with hyper-personalization of insurance, you might actually get to a point where you end up with a societal problem, which actually we are unsure how it's going to get addressed, if not by regulators, where you have a swathe of the population that is uninsurable because the net present value is something unaffordable for them.
So unhealthy people won't be able to afford insurance.
Correct.
Healthy people will have very cheap insurance because it's an accurate reflection
Exactly
of the
right.
situation.
And that's horrible if you think about it. And
Well, you say it's horrible. It's more like looking reality in the face.
It is like looking reality in the face. But the reason why I don't think we're going to get there is because regulators understand that if you have this type of insurable and uninsurable division, the uninsurable are going to become a cost to the states. And as a result, it's going to be a subsidy if you want. And so I don't think regulators will allow that hyper-personalization. In the same way, AI for credit scoring is another.
Yeah, I mean, I quickly touch on AI from credit scoring, because actually if you let an AI run your credit models, and there's been some testing on this a few times, particularly, let's say you take a city, what ends up happening is that they will end up creating this concept of tail risk, right? The tail, the uninsurable tail, or the unlendable tail comes in, and then it not surprisingly ends up in the inner city, in the disadvantaged areas.
Doesn't that happen already, though? Is there not already systematic bias?
It shouldn't.
Yeah, I mean, there is an element. It does happen already, and that's part of where the regulators become, more important. A lot of this, it's quite interesting. A lot of what we're seeing now often gets predicted by science fiction. So if you ever watch the movie Gattaca, this is all what Matteo was talking about. It was all predicted, right? You do one genetic test and it says whether you can do this or whether you can't do that, or Minority Report, which is another one.
Or Elysium. I mean, we can.
But it's interesting. You see a lot of that. This is all sort of coming to
bringing
fruition.
the future into the present, and really, it's precisely calculated.
I mean,
and financial services,
scary in a way.
It is scary in a way, and financial services is at the core of this.
Yeah.
People think, when we talk about financial services, people think about, that's the boring thing that I do when I go to my bank and I kind of get my health insurance. Not at all. No. In fact, you probably remember actually that a couple of years ago, I think it was Andreessen Horowitz said in 10 years' time, every company will be a fintech company. We fundamentally disagree in the sense that in 10 years' time, no company will be a fintech company.
Because finance will be so embedded in
everywhere.
Everywhere. So you won't even see. So I don't even know what a bank is anymore.
Correct.
Or what a bank
and
does.
You want.
And
you want. The fact that banks until today have been focusing on brand recognition. And I mean, honestly, you got, whether the dollar of loan that you get is from bank A or bank B, it makes no difference to you. The product is undistinguishable. The only differentiation is risk, the counterparty risk, and that's it. And when Uday was mentioning earlier on what you wake up in the morning wanting, you certainly don't wake up in the morning wanting a mortgage, do you? You want a house.
Good.
You want a house. And so the financial product is completely embedded in your desire. And ultimately, you're going to end up buying a house with stapled to it, the mortgage, which will be priced on the spot. And you don't care who's providing it to you. Why would you care?
100%. And actually, this is one of our core theses, right? We have three big core theses that we're investing into. One is embedded finance. The other one is democratization of finance, which is what the hyper-personalization. That's the democratization, using technology to bring cheaper financial products to a wider group of people. And one of our investments in this new fund is a business called Moneybox, which does that at a very mass market level within the United Kingdom. That business has grown from 5.4 billion pounds of AUM about 18 months ago to over 18 billion pounds today, right? Because it's for 25 to 35-year-olds, first time they're putting money into an account, and it helps them invest it, intelligently, right, using technology. And it's really the zeitgeist. It's sort of, that's where people are thinking. And then the third, of course, is the deepening of the digital economy, and every economy becomes more digital, and we're focusing on the digital transaction layer, which is quite interesting. But if you go back to the embedded finance point, which is going to be probably the largest part of growing financial services today, the world's top 30 banks are worth $3.5 trillion. This market, it'll be worth $7 trillion in 10 years. Like, one of the things, like a very real example is I'm going to get the new iPhone, right? Because I've had my iPhone now is 2 years old. So I need to get the new iPhone. So I was checking out the new iPhone. So now Apple, as of this iPhone, they've just launched it. We anticipated this because we've been talking about this for the last year.
It's in our pitch deck of 3 years ago.
Exactly. So Apple on this iPhone have now launched the subscription for the iPhone. So you can walk into an Apple store and you will no longer have to buy the iPhone, but you subscribe for the iPhone. It ranges from, I think, £50 to £100 a month, depending on the model of the iPhone that you're getting, because there are different models which have different price points. And within that service, they include everything. They include the insurance for the handset, the repair for the handset, essentially the implicit financing of the handset. And every 12 months, they will give you a new handset. And it
Do
becomes
they
a
include the
subscription.
line already?
They haven't done that
They
yet.
haven't, but they will.
They will.
That's the reason why you have an
They'll roll it
eSIM.
all up.
That's
It's like car leasing, really. But
Yeah,
for mobile
100%.
phones.
But car leasing is interesting. The difference between car leasing, this is in the car leasing, the residual value risk is still with you on the car lease, right? Because you lease it for some time and then you have this residual value risk. Now you have cars at subscription for cars. So Jaguar Land Rover has a service called Pivotal, which you can subscribe for any of their cars, a Range Rover,
we had the head of Pivotal coming to speak at our
exactly, and that's a real subscription service, because again, every 6 to 12 months they can give you a new car, and it includes the insurance and everything.
So car leasing is one element of what we call, and frankly they call, a mobility subscription. What we're talking about with the iPhone will eventually become a full-on telephony or even communication subscription. This is the concept. You move from the ownership economy to the experience economy. You move from the fixed job economy to the gig economy. And why is this relevant to financial services, the move to gig economy? Because remember what I was talking about when I said about micropayments? It's exactly that. The moment you move to the gig economy, having fast, efficient, frictionless payments is necessary. And it's an essential element. So removing that friction, allowing you to get micro insurance for those 3 days a week that you actually drive for Uber, and having a different type of insurance, worker insurance for the other 2 days when you, go and teach evening class at university. So having this type of portfolio careers from day one will be enabled by fast, frictionless payments, highly tailored insurance products, and overall the embedding of the financial products into the goods and the experiences that you want to enjoy in your life.
So what we're looking at is the underlying companies that actually provide these services.
So that's what I'd like to come on to. But so just it feels to me like it's a bit like business to business. It's a business asset light model, software as a service, everything. But it's also a little bit World Economic Forum, you will own nothing and be happy type thing. And that's the kind of the dystopian element of all of this. I like owning things.
But you like owning things.
But I suspect we're the same generation.
We're all the same generation. Okay. That's the reason. Exactly. We're all the same generation. And we have this thing about asset ownership. And then you talk to sort of Gen Z and beyond, and
not everybody actually is interested in owning.
Yeah, they are more in the experiential stage. They want experiences, and they don't necessarily want the issues of owning stuff, right?
It could be more Buddhist, or maybe I'm too attached to the material. It could be better. I don't know. But there's this really interesting question. You've outlined this kind of brave new world, but I'm just trying to work out, well, okay, who wins? Is it? I can see kind of two scenarios where Apple just basically buys up
the client owners.
Yeah, everything.
The client owners. That's my view.
Yeah.
My view is that who wins is the companies, the brands, the logos, if you want to put it like that, that own the client relationship. Because
customer facing.
Yes.
Brands.
Because ultimately we're talking about B to B to C.
Yeah.
Now, having said that, the Apples, the Googles, etc., will not be able to actually provide that without highly specialized, extremely experienced, very technical fintech providing those particular financial products that they can embed into their, mobile subscription model, et cetera, et cetera. That's the way I would put it. So I think there is room for both to win. And that's why what we do is B to B to C. We believe that the B2B is definitely super interesting for us for financial services. We believe that financial services is becoming B2B. Mm-hmm. But we believe that the client ownership is also going to win from this hyper specialization. Who's going to lose, I think, is the large balance sheet institutions that do not innovate, that do not understand that their path to market is no longer going to be through having high street branches, but it's going to have to be through the connections, the emotional connection that customers have with individual products and individual experiences rather than with stepping into a high street branch.
Well, people have a much greater emotional connection with Just Eat than they do with their mortgage provider.
Of course, 100%.
I mean, if we go back to the Jaguar Land Rover example, what is the main reason Jaguar Land Rover set up Pivotal? The main reason they set it up was that as a car manufacturer, you really don't have a relationship with your customer, because
It's one-off.
a customer buys it through the dealer,
Oh,
and then the dealer is the one who's actually doing the servicing of the car. And so the only time you have a relationship with the customer is when the car comes out of your factory and the customer comes picks it up, because they have a program that allows you to do that.
But you're still saddled in Europe with having to junk the car when it's taken to a junkyard, and you have to recycle it. So you're saddled with the leftovers, but you don't have the client relationship in the middle.
Yeah, and so for them, this was an obvious thing. How do we actually bring the customer relationship? We create a subscription service. I think it's the same thing for Apple. And this is going to be the battleground. The battleground, as Matteo was talking, the battleground is going to be who owns the customer, and that's why embedded finance is such a core part of the tool set for all of these people to actually own the customer, because by creating this relationship with the subscription, they own the customer.
But the reason why I mentioned the leftovers and the junkyard is because also it solves that issue. Basically, by having a subscription service, effectively for the first, let's call it 6 months of the car's life, the car is with the end user, the private consumer. And every 6 months, they get a new car, 6 months, 3 months, 12 months, whatever it is. Then those cars are taken back by the OEM, by the manufacturer, and given for carpools, fleets, or what are they called? Corporate fleets.
Corporate fleets,
and there they spend the next 2 years. And then they just get retired, they get stripped down, they get overhauled, and all of a sudden you got a new car. So it solves also the recycling issues. I mean, it's huge.
And then solves the
brand.
You remember I touched on leasing and residual value?
Yes.
So there's no secondary value for that asset in the market anymore, because they don't trade in the secondary market at that point. So they literally control the value prop.
Yes.
And the way leases work is, it's the difference between the purchase price and the residual value that's then amortized over the period of the lease and a financing charge on top. And so if you control that, you actually can control that entire pricing and value chain, becomes super competitive.
And you control your brand perception, because there are only new Range Rovers on the streets.
Yeah, there's far fewer secondhand cars. Now's the time to buy a classic car.
It is.
It is. And so this is the way, and we're going to end up in this quite an interesting world where there's going to be a big fight, I think, for these brands to own the customer, because that's, as Matteo rightly pointed out, that's really where the value is going to accrue, the biggest value. And it's always been the case. Distribution has always got the biggest chunk of value in a value chain. That's going to continue. So by owning the customer, they will continue to do that. And that's going to become that. Then you need to juxtapose on top of that a world of agentic AI, which we were touching on. And agentic AI is a counterbalance to brands, because I was actually at a very interesting conference the last few days called The Futurist, where there was a bunch of futurists from around the world talking. And one of them people was actually one of our people we know very well, MasterCard, and the head of marketing for MasterCard gave a very interesting presentation where it talked about marketing and where does marketing go into the future. In a world of agentic AI, marketing fundamentally changes, because if you tell your agent to buy your next sneaker, based on all the
everything
data
that it knows about you.
The color of the logo is not going to play a big...
Exactly. Everything that it knows about you and the technical things, and you tell it to go and get the best discount, and you tell it... By the way, this is real, because Perplexity has just launched a browser that has an agentic AI. Comet, exactly. That has an agentic AI built in, and actually you could tell it, and it will go and make the purchase for you, and you're done. What is the role of marketing
you can use
in that world?
ChatGPT, agent mode. I mean, they've all got it.
And there's no role for marketing at that point. Marketing has to be to the agentic AI.
So I was going to ask you, what is the counterbalance to the potential for parasitism, for parasites, owning the whole stack? And you've just given me the answer to empower the individual at the absolutely personalized level of agentic AI. So
it is exactly that. Look, as you can tell, when we tell individuals that we invest in financial services, everybody goes like, "Oh, boring. I mean, this is such a boring sector." But actually, we don't see it like this.
To this podcast,
we don't see it like this. We think it's so central. It's so interesting. It's literally at the forefront of how society is getting transformed. And it's probably not by accident that neither you nor I actually studied finance. I did philosophy, he did medicine. So that's the type of, we love where we operate because it's really interesting and it's really at the center of how society is getting transformed.
I mean, that's before we even get into like the fundamental, where the evolution of the world in a world of AI, universal basic income. How do you actually design a financial system to deal with like universal basic income, a different way of an economy running? All of that's going to
the move of the individual from being a producer to being a consumer, and that's the role of UBI. I mean, this gets really, I mean, way beyond the scope of this podcast, but it's really, really interesting. And financial services is at the core. Ultimately, it is at the core.
I mean, it has to be. If you think about UBI, universal basic income, where you pay everybody a basic income, you need to build an asset management infrastructure within a country that actually can deal with universal basic income. And that is itself a disruption, and that itself creates opportunities because of the way you're thinking about asset management evolving. And so
that's just a reverse tax system.
Yes,
in a way, yes.
Yes, it's a redistributive. Yeah. It sounds like it's a redistribution methodology, but if you consider we are now at a stage where the return on capital is higher than the return on labor, you want to do the redistribution in order to ensure that people who are not owners of capital can afford to purchase the goods that are produced by the owners of capital.
Yeah.
You understand how slippery is what I'm talking about here.
It also makes it all the more important to encourage more people to actually have capital investments and savings.
100%.
Exactly. And that's where the money boxes come in, right? These sorts of platforms that we're investing in, that's exactly where they come in.
So we've, as I probably, I think I mentioned to you before, we are sector specialists, sector focused, but we're completely geographically agnostic. And so, opportunistically, we started our ride, actually not in Europe, we started our ride in Asia and Africa in 2014, and then slowly expanded.
It's quite an unusual way around.
It's quite an unusual way around. We basically leveraged where there was capital to be invested. If you remember, in 2015, you had Africa Rising, you had the Eastern Tigers, you had all of that, and so and India was absolutely
it kind of makes sense the way that those countries leapfrogged the legacy
100%
infrastructure, and now you're bringing that and the cutting edge stuff.
Yeah. That was the first research that we published in our spare time between 3 and 4 a.m. We published research, and the research that we published, the very first one, was on so-called reverse innovation, which is exactly what you just described. It's the concept of taking innovation from markets that don't have an existing infrastructure, that therefore are free to create what with current technology is the most efficient way of doing things, and then taking it and exporting it in countries like Western Europe or the US, where the existing infrastructure sometimes hinders a little bit the development of new wild ideas on how to run things. I mean, I always say that the creation of wallets, of financial wallets, like well, actually, so many challenger banks are in reality wallets here in the UK. First was created in Kenya. M-Pesa. It was when effectively individuals started using airtime credits as a way to exchange money at a distance. And so at the time, Safaricom, which is owned by Vodafone, so that there were these really weird flows of airtime credit, and started trying to understand what's going on here. Why are people sending each other airtime credit? And they realized that it was being used as a currency, and therefore as a store of value, and therefore as a wallet, a digital wallet. So much of the innovation that we think is from the West, in reality has come from other parts of the world. But the reason why I was mentioning that when we started there was that we saw exactly the potential for the democratization of finance, not just as the right way to do things in terms of ensuring that the unbanked were actually banked, but because financial services has such a role for speeding up, for fostering the growth of the economy in any given country. And so removing those frictional elements in payments, in insurance, in credit, and making democratization of finance, as Uday was mentioning, accessible, or rather making it a reality, and making financial products accessible to all, and I'm reconnecting it to your point about wealth management, is absolutely pivotal in developing an economy. And that applies to Europe as much as it does to the US. Wealth management needs to become, and is becoming, significantly more personalized, significantly more agentic, significantly more efficient, to the point of offering, and there'll be issues, but to the point of offering access to previously precluded assets and products like private equity itself to the masses. Why should savers not be able to benefit from the superior returns that private equity does offer? If you can deal with illiquidity, that's not a problem. You can structure around it. We're bankers. We know how that can be done.
Yeah.
But it hasn't been done to date. And I think technology, AI, Web 3.0, etc., gives us the ability to actually create that situation, to enable that and to enable wealth management for the masses.
I mean, but even at a more basic level, right? If you think about United States, Europe, you'd be surprised what a large percentage of the population lives day to day. So they have very little money in their accounts. They're literally living day to day. They're borrowing money between paychecks. They have issues. They're not covered by medical insurance. These sorts of issues, these are all the sorts of issues that all of democratization of finance solves, right? You don't want to be in a situation where, as a family, you have £1,000 in your savings account, your child gets ill, and you need to spend all of that money. You start to you go to square zero. It's the same problem that exists in emerging markets that exists in developed markets. We seem to think that they're different, but they're not that different in many levels.
You see, these issues are not exclusively, by all means, I'm not making that argument, but at least in part, they are the result of inefficiencies, of frictions in the financial system. And we think that technology, we think that new business models, that innovative ways to access the clients and to distribute the products have the power to remove those frictions, have the power to remove those inefficiencies, and as a result, ever so little to decrease some of those unfairness in the distribution of assets, in the distribution of access, in the distribution of frankly, wealth.
Well, that's probably the perfect place to leave it, but I can't resist asking one more question, which probably constitutes something of a faux pas when in the institutional world, because people might talk about crypto, but no one's ever going to talk about Bitcoin. But let me put this to you, that everything that you've thus far described is incredibly disruptive to the status quo. But Bitcoin is incredibly disruptive to everything you've just described, isn't it?
It is and it isn't. I think so.
I agree. Actually, it is, and it's a part of it.
Yeah, and it's a part of it, right? So I think you need to. Bitcoin is one form of stored value, right? Yeah. Gold is a form of stored value.
They're very similar,
but it's also a medium of exchange.
It's a medium of exchange, as is gold.
Yeah.
So people.
Gold is a currency. That's what I always tell people.
Gold is a currency.
It's not very useful, actually.
Yeah. So why do people want Bitcoin, or why is now Bitcoin becoming a bit like gold, which is becoming part of everybody's portfolio a little bit there? Because people want to have something that's entirely uncorrelated to central banks who control monetary policy. So they want a store of value that's uncorrelated, that acts as a hedge to typical currencies that are controlled by central banks and interest rates and etc. And that's part of the reason we've always had a fondness, I guess, as the human race for gold, because that was the de facto standard. Now you have an electronic version of that, which is Bitcoin. So it's actually forming part of the financial services infrastructure in a way.
And it's part of the solutions that we were talking about, Bitcoin or others, to be honest. But let's
could be
use
Ethereum,
Bitcoin.
it could be
anything.
Solana. I mean,
yes. But how is it part of it? Because again, the transfer of Bitcoin from one person to the other is frictionless, it's instantaneous, etc., etc., etc. It is not part of it because it is ultimately completely unregulated, and I do believe that stablecoin probably offer at least a first step that is more likely to be embedded in the existing financial system, that is being embedded in financial system today. The volatility of Bitcoin is such that it's unlikely that a money transfer business, for instance, would use Bitcoin for its internal transfers, when money is being sent from the US to Nigeria, for instance, whereas a stablecoin is exactly the right way to do that.
I mean, just to put it into context, today stablecoin volumes are greater than Visa and MasterCard's volumes combined.
Yeah.
So that's already today. We're already in a world where this is becoming a big part of the financial services infrastructure. And it's very important to talk about that, because that's the other thing that we do. We like to focus on the infrastructure.
So how many hours do you have?
I know, I've got to say, this has been way more fascinating. I mean, I thought it would be interesting, but this has been absolutely fascinating. And I probably had that bias as well, that financial services and fintech is a bit meh, but this really is where it's at. So you guys are doing some really interesting stuff, and I hope the next fund goes as well as the previous too.
Thank you very much. Well, we are really enjoying ourselves.
Yeah, absolutely. Thank you very much.
Brilliant.
Thank you.
You've been listening to the Fund Shack podcast. Wherever you're listening or watching, please click follow or subscribe. That's all I ask. Thanks for listening.